You know, for what feels like forever, investors have all been chanting the same mantra: cash is trash. It was repeated so often, it basically became financial law. But what if, here in 2026, that idea isn't just a little wrong? What if it's actually dangerously out of date? We're about to dig into why the entire game has fundamentally changed.
So let's start with the core belief that really drove this whole mindset. Robert Kiyosaki, he put the fear into words perfectly. For years and years, every single dollar you managed to save was just a sitting duck, constantly having its value chipped away by forces you couldn't control. Holding cash honestly felt like you were choosing to lose.
And this number, this is the main villain of our story: inflation. A 3.6% inflation rate meant that every year your pile of cash could buy 3.6% less stuff. It's like this silent tax, this invisible hand reaching into your bank account. It made the whole idea of saving seem kind of pointless, right? You had to invest, you had to take on risk just to keep your head above water.
Okay, so here's our game plan for this explainer. First, we're going to tear down that classic cash is trash. Then, we'll get real about the hidden dangers of being fully invested all the time. After that, we'll uncover the one number that changes everything. We'll dive into the power of this new financial world, and by the end, you can decide for yourself. Is cash still trash, or has it become a super powerful strategic tool?
All right, first things first, let's take a little trip back in time, back to the world that created this mantra in the first place. Because to really get how much things have changed, we have to understand the environment that made holding cash a guaranteed losing proposition for more than a decade.
So check this out. This was the brutal, bleak reality. If you put your money in a bank savings account, you were lucky to get less than 1%. Now factor in that 3.6% inflation, and you were literally locking in a loss of over 2.5% every single year. And money market funds? Even worse, basically zero. You were guaranteed to get poorer just by standing still.
So what was fueling this? Well, a huge driver was this policy called quantitative easing, or QE. The easiest way to think about it is this: central banks basically turned on the money printers, creating trillions of new dollars and flooding the system with cash. It's like adding a ton of water to a glass of juice. It just diluted the value of every dollar you already had, and it slammed interest rates down to the floor, forcing everyone to chase riskier investments.
So yeah, the message couldn't have been clearer. Get your money out of cash and into the market. But this advice, well, it kind of glossed over a really critical fact. The stock market doesn't just go up. Being all in all the time carries some pretty big risks that we tend to forget about.
You know, risk isn't just some boring textbook term. It's the real-world, gut-wrenching volatility that could force you to sell your investments at the absolute worst time. And history is full of what people call lost decades. I mean, after the dot-com bubble, the NASDAQ, the tech-heavy index, it actually gave you negative returns for 10 years. Even the broad S&P 500 went pretty much nowhere for 13 years, from 2000 to 2013. The path is rarely a straight line up.
So this creates a massive problem, right? A huge dilemma for any smart investor. If your only two choices are, 1, lose money for sure every year in a bank account, or 2, potentially make nothing for an entire decade in the market while your stomach is in knots, what do you do? Where on earth do you park your cash safely while you wait for a real opportunity to pop up?
Well, the answer to that question, and honestly, the key that unlocks this entire new investment landscape, has been completely transformed by the return of one single, incredibly powerful concept. And that concept is really embodied by the good old money market fund. For years, they were a total afterthought, paying you basically nothing. But their whole purpose, their reason for existing, has never changed: to be a super safe place for your cash. Their goal is to never ever break the buck. In other words, a dollar in is always a dollar out. Now, the yield you get from these money market funds, because they hold incredibly safe stuff like US Treasury bills, is the closest thing we have in the real world to a risk-free rate of return. And listen, this is not just some fancy finance jargon. This is, without a doubt, the single most important number in the entire world of investing. I love this quote because it just makes it so simple. Think of the risk-free rate not as some complicated investment, but just as a ruler. That's it. It's the baseline. It's the measuring stick that you hold up against every other possible investment. Any other opportunity has to promise a return that's high enough to make it worth taking a risk above what this simple ruler is offering you.
So, what happens when that measuring stick, that ruler that for a decade was barely an inch long, suddenly becomes a full-blown yardstick? Well, welcome to the new reality of 2026. This is the 5% world. And let me tell you, it changes absolutely everything.
Okay, this chart just lays it out perfectly. On the left, you've got a money market fund giving you a 5% yield. That's your safe, liquid, risk-free choice. Now look to the right. The average dividend you get from owning the 500 biggest US companies is just 1.3%. For the first time in a very long time, you're getting paid way more to take zero risk than for taking on all the risk of the stock market.
So this forces you to completely rethink what risk even means. With a 5% money market fund, your money is safe, the return is pretty much guaranteed, and you can access it whenever you want. To jump into stocks, you have to accept that your principal is at risk from all that volatility, the returns are totally unguaranteed, and everyone tells you that you have to hold on for years. The huge question for 2026 is, why take the risk?
But hang on, it gets even more interesting. This isn't just a story about interest rates going up. At the exact same time, there are these powerful tech changes happening under the surface that are cementing a brand new, permanent role for cash. It's being transformed from just this lazy, idle asset into a high-tech tool for our digital future.
I mean, just look at this timeline. It shows this wild evolution of what money even is. In '71, we completely cut the cord from a physical thing like gold. In 2009, we started this era where money was just a policy tool, created out of thin air. And now with things like the Big Genius Act in 2025 and tokenized treasuries coming on-chain in 2026, money is actually becoming a native digital asset, living on a blockchain.
The core tech making this happen is called real-world asset tokenization, or RWAs. And this is not some fringe crypto idea. No way. This is being led by the absolute titans of finance. We're talking BlackRock, JP Morgan. They're taking traditional, boring, trusted things like US Treasury bills and shares of money market funds and putting them directly on a blockchain.
So why are they doing all this? Because when you put these assets on a blockchain, they become incredibly efficient. Instead of waiting 2 or 3 days for a transaction to clear through these ancient banking pipes, it can happen instantly, 24/7. This programmability means your cash is no longer just sitting there. It becomes a high-speed, intelligent building block for this whole new digital economy.
All right, so let's bring it all home. We have traveled from that old world of 0% interest all the way to this new high-tech reality of 2026. It is absolutely time to recalibrate our thinking. The role that cash plays in a portfolio has been completely and totally redefined.
The really crucial takeaway is this evolution right here. We started in a world where cash was a problem you had to solve. The whole game changed when that risk-free rate shot up to a compelling level. Now, in our new reality, that 5% yield makes cash a powerful asset all by itself, a place to get a solid return while you wait for great opportunities. And looking ahead, technology is just making cash an even smarter, more strategic tool.
Look, that whole cash is trash playbook was built for a world that simply doesn't exist anymore. The entire framework has shifted. For a decade, the biggest risk was not being invested. It was sitting on the sidelines. But today, in a world where safety itself pays you a really nice return, maybe the biggest risk is taking on unnecessary volatility. So the question to leave you with is this: how does that change your strategy?